financing, and this comes just 2 months after you raised $200 million for your company at a roughly $2 billion valuation. So why don't we start off on the heels of this big news by just explaining what is Divvy Homes, what is the business model?
Sure. So first of all, Julia, thank you for having me on. I love TechCheck, so it's an absolute pleasure. So Divvy creates homeowners. We provide an alternative for people who cannot access mortgage financing in today's market currently. And the way it works is customers come onto our website. We approve them to go out shopping at a preset budget. So we'll say you're approved for example, a $350,000 home in Houston. You go out shopping for a home. When you find the home, Divvy puts out an all-cash offer for you. You move into the home at closing and you put 1% to 2% down. So you're technically a renter, but you build up initial equity account in the property. And then every month you pay part rent, part equity, and the equity builds up your ownership. You can take us out by getting a mortgage and rolling your equity like a refi, or you can walk away and we'll cash you out for your equity.
So it's effectively a rent-to-own model that makes ownership more accessible to people who wouldn't have been able to afford a big down payment?
It's not just a down payment, actually, which is, yes, rent-to-own for sure, but I'd say it's down payment. I'd say our biggest customer base actually are people in the healthcare field. So they tend to be people who have a lot of student debt. So coming out of technical or trade school and having a lot of student debt. Our second biggest area of customers are actually teachers. That tends to be a down payment issue. And our third biggest area of customers are actually 1099 workers. So think Uber driver, Instacart delivery people, but the income streams tend to be a little bit volatile, and it makes it really challenging to get a mortgage. In fact, today it's quite challenging. In order to get a mortgage, the average FICO you need is actually a 760, is where new home purchase FICOs are. And with rising home prices, it makes it challenging both to save and then also to maintain a consistent debt to income ratio.
So interesting. So tell us about why you just raised this 200 million and then this 735 million in debt financing. What will you be using that for?
Sure. So the 200 million was led by Tiger Global and Caffeinated Capital, and it was fully preempted. So it's 6 months after our prior round of capital, and we're going to be using the money primarily for growth. So in order to grow our platform, we need to be able to buy homes. So that's a core part. And so it'll be investing in people within market to help build out our platform, engineers within in some of our bigger markets like San Francisco, where we have headquarters in, and then investing in actually building out our sales force internally. Our goal is deeper market penetration. So we're in 16 markets today, and it's really to get up to, call it 3 to 5% market share within each of those markets. And be able to grow that way. So that was the 200 million of equity. On the heels of that, we actually need debt capital in order to purchase the home. So we announced we raised $735 million worth of debt capital, and that'll actually be used to finance the purchase of the home. In total, we actually have close to $1.1 billion, including our existing facilities, in order to go purchase homes.
And so you're actually purchasing the homes and then basically renting them back to the owners. That is a very cost-intensive business model. Why does this make sense for you from a business perspective?
Yes, completely. Well, it's actually a really profitable business for us as we're technically a landlord. And so the way that we work is we go out and we purchase the home for renters. Renters then pay us rent. We pay out all maintenance, all taxes, all insurance, all utility, HOA costs that are associated with it. We take care of those costs for the customers. Now, the bet that we make here is that ultimately we get better renters. So if you find someone who ultimately wants to be a homeowner, that they will take better care of the home and they will turn over less frequently. And so as a result, it's a net win-win, which is the customer gets the house they want, they get to build up equity, and we ultimately can do that and give up some of the upside because we have less costs because customers turn over at a lower rate.
You know, I've been reading so much about the housing shortage and also the volatility in home prices. You are now exposed to all of those issues. You know, I'm in Los Angeles, you live in San Francisco, I believe, and there's so many different factors that play into housing prices right now. And if you're a company that's buying the actual real estate, how do you take into account all those different issues that could make the prices of houses so volatile and expose you to that risk?
Julia, you know what's so funny is when I was raising capital very early on, I used to get asked the questions of what happens when home prices decline. Now, one venture capitalist asked me what happens when home prices skyrocket, which is what we're seeing in inventory tightens up. So what we are seeing is that home prices are up about 20% year over year. While that's great for our existing portfolio, meaning all of our customers' buyback rates are mostly in the money, meaning that they can buy the house at cheaper than what the market is trading at today. So it's great for our existing portfolio. It does make it more challenging to actually purchase a new home. However, I think that that's where Divvy comes into play, which is that we are an all cash bidder on behalf of our customers. So that means that our customers can now compete with institutional players who are going to be bidding no cash, no due diligence days, no appraisal contingency. And that is how we come across. So I would actually say that we help our consumers in what is a tighter economic environment. Now, overall, from a macro perspective, I would say we're living in a very strange time. So we do lack a ton of supply. Building new homes has become increasingly more challenging with supply constraints, especially on lumber. So being able to build new homes has become challenging. And so my view is that we're going to be in a situation where home prices are going to continue to rise, at least for the next, call it 2 years or so.
And so what does that mean for you as a business? And who do you see Divvy Homes as competing with?
So I think what that means is that our customers are going to need us more now than ever before. So what we see is that as supply declines, so there's less supply, more people are demanding to be in single family homes because COVID, everyone's working, living, their houses now, they're like, where their kids go to school, where their office is, everything in one. There's more people who actually are demanding to be in a single family home. The result of that is that home prices rise. The more that home prices are rising and incomes aren't actually keeping up with that, actually means that it's more challenging to get a mortgage. The more challenging it is to get a mortgage, the more people use alternative home financing like Divvy. So I actually think it'll, very much help support our customer base as we continue to grow.
You laid out earlier some of the types of people who are typical Divvy customers, but looking broadly, what is the full addressable market for your service? It's not all 43 million housing units occupied by renters, because it seems like Divvy isn't really for everybody. It is more for a particular type of person who would rather be owning than renting. Lay out what you think the potential business is here.
So there's actually about 15 of the, call it 45 million or so renters in America. About 15 million are actually in single family homes. And if you actually survey those people, about 90% of them said that they would want to be homeowners rather than renters, which is mind blowing because most people think, hey, you're choosing to rent, it's for a particular reason. Actually, most of the time, they actually want to be homeowners. And if you think about it, no one's moving out to the burbs and being in a single family home, right? If they don't ultimately want to be a homeowner. And so we actually think there's a tremendous addressable market. I think this, which there are a decent amount of single family rental companies that are actually public today. And the largest one, actually, Invitation Homes, has 80,000 homes. So if you see the addressable market as the 15 million single family home renters who maybe ultimately 90% of them want to actually be homeowners, you only need about 80,000 homes to even beat the largest player in the space. Fun fact or interesting fact for you is we're actually in 2021 will be one of the top 5 net acquirers of single family homes in all of America on behalf of our customers. So we're pretty much competing at pretty high levels of growth in order to make sure that our customers can access homeownership.
And so who's the main competition then? Are you competing more against the rental market or against other companies in your space, financier type companies?
It's a great question. I'd say if we lose customers, most of them have rental leases that come up, and so they can't make it through the entire closing process, or they need to move quicker. So we lose customers to rental platform, to just going back to being a generic renter. If folks can get a mortgage, we actually really encourage them to. We will be very transparent with our customers, which is mortgages are backed by the government. Divvy is not backed by the government. I can't offer you as cheap of a rate as you can get from a mortgage. And so I highly encourage people, if they can do that, to go do that. And then if you're not ready yet for a mortgage and you actually don't want to continue to rent, that Divvy puts you on this path. We've released a stat, which is almost 47% of our customers whose leases have come due have actually bought back the house from Divvy. That's almost 10x the closest competitor in our space. And so I think what our customers take away and what we really want to emphasize is we create homeowners. We are really helping you on your path towards eventually owning.
You also have some interesting statistics about how Divvy is helping the renters through your system, or Divvy customers rather,
Yeah.
generate more in savings than typical renters. Explain that statistic and why you think that's the case.
Sure. So look, Divvy's a forced savings mechanism. You come into our homes, and the whole goal of it is actually to be able to continue to save up equity in those properties. And so on average, our customers have saved up $8,200 on average. Considering every month that's growing, we have customers who have tens of thousands of dollars saved up in their properties that look, they can roll into a mortgage and use it as their down payment on their mortgage. Or if they don't like their neighbor or they don't like the house or they have a few extra kids and they weren't planning on it, they can actually just cash that out, right, and walk away with thousands of dollars. And on average, just kind of the stat that you were mentioning before, $8,200 saved up in a house is almost 10x the average savings rate for renters across America.
So tell us a little bit about your journey. How did you come to found this company and get so focused on solving this problem for renters?
Sure, Julia. It's an insanely personal story for me and something I'm deeply committed to. I grew up in a fairly low-income family. My dad had immigrated to the U.S. and when he came over here, he actually didn't have a FICO score and couldn't get a mortgage. Him and my mom had gotten pregnant and they needed a house, and they were fortunate enough that they found a woman who provided them with seller financing on our property, which was everything to my parents. And so they stayed in the house for a number of years. They actually built up some savings, built up a FICO score, and eventually got a mortgage. Refinancer just took the woman out from the equity position and were able to actually take some cash off the table. And they used that cash to pay for me and my three siblings to go to college. And to me, this is so important because this is the definition of the American dream, which is the average American saves in their home. This is their form of investment. This is how they compound wealth over time. And for me, that's been the case with my family, and it's something I want to provide to more Americans.
And so you effectively want to systematize and make accessible this experience that your family just happened to be lucky to have with one individual woman. You want to turn that into a scalable business.
Well, I'd also say that, thinking about it, we had the global financial crisis over a decade ago, right? And what happened is there was from 1980 until mid 2000 and call it 2006, 2007, there's an entire population of people who were able to become homeowners and then got cut out when mortgage underwriting tightened. And while maybe they're not ready yet to get a mortgage, they were going to either be a home buyer or a renter. And with Divvy, they are ultimately a renter, but we're forcing them to save and be ready to actually be a home buyer. And so there's an entire swath of people who have been cut out from the market who Divvy is now able to serve and put them on a path towards savings. And that to me is incredible. Not only savings, but savings in an asset that's appreciating, and they get the benefit of that appreciation, right? It is making homeownership within reach for them.
And Adena, before we go, I want to hear a little bit about where you are right now. You're at the Fortune Most Powerful Women's Conference in Washington, D.C. right now, and taking some time out from one of those sessions to talk to us. Tell us a little bit about what you're learning there and what the experience is like being at that conference right now.
Oh, it's so incredible. I feel so grateful and thankful that Fortune has allowed me to come because I've met the most amazing set of women here. What's, I think, most distinct about being at this conference versus other conferences is that the focus here is really on building mission and purpose-driven companies, which is something that maybe hasn't come out as much in other conferences. We're focusing on creating inclusive environments and creating pathways and purpose for employees to be able to grow and feel like the companies that they're working within are projecting values that they can relate to. And so that's been the core topic that we've seen here, and an amazing set of women and speakers that have been present.
It must be pretty cool to be back in person as well. I went to my first in-person conference recently. Just a quick final question for you. Are you back in the office? Are your employees in the office, or what's your flexible work situation?
So I called it, this is not a good term, but I call it flexible first, which is if you're a mom and you got to work from home because your kids are home, work from home and do what feels right for you. If you want to be in office, we'll have an office ready for you. It is do your best work, and I will support you in any way that you need to do the best work that you can possibly do. So flexible first is our official work situation.
Well, flexible first, and now you get to flex at a cool conference and focus on the sort of purpose of all of these different companies. Adena, I'm so grateful that you talked to us this morning on the heels of your big fundraise and also that debt financing. Sounds like a lot is going on with Divvy Homes, and we were grateful to get a window into it this morning. Thanks so much, Adena.
Thank you, Julia, for having me. Take care.